I remember my boss on the trading floor, I asked, like it's the first day on the trading day, like, oh, what do you do with your own money? What advice can you give? But it's like, Karolis, I don't gamble with my own money. I think index is the best thing. If you don't use your specialty skill to do what you do best, which for me is Sale-Leaseback, Net-Lease investment, then an index, safe. If you look, again, jokingly, along people who started the businesses like Donald Trump, they say, it's anecdotically, he started his empire with a small loan from his father of $1 million. And people say if he had put that $1 million on S&P 500, he would be wealthy, way wealthier today than what he has.
Welcome to the People Property Place podcast. Today we're joined by Karolis Adlis, International Investments Executive Director at WP Carey. Listed on the New York Stock Exchange, WP Carey is one of the largest diversified net lease REITs, specialising in the acquisition of operationally critical single-tenant properties in North America and Europe. Karolis worked in banking and has held roles at UBS and Jefferies before moving to WP Carey in 2015. He has responsibility for sale and leaseback, build-to-suit finance and net lease acquisitions across Europe. Karolis, I know you're a listener of the podcast yourself, but it gives me great pleasure to welcome you on today. So thanks so much for coming to our podcast studio.
No, Matt, thank you so much. Very, very nice to be here. I appreciate having the opportunity to come here and share my thoughts. I appreciate that.
Not at all. Well, look, we'll get on to WP Carey and your views on the market and debunk some of the technical terminology that comes with kind of net lease investment. But a place I always like to start these conversations is like, how did you get into real estate and where did that factor in terms of your psyche?
No, absolutely. So like you said, a big fan of your podcast, listened to quite a few episodes, and it sounds like the common theme or common trend is people kind of stumble upon real estate. No one really is planning from their high school years to be a real estate investor. So similar to me, finished high school, went to study in UK. Originally from Lithuania, I went to international school back home, went to study in UK, did a business degree. Like I thought every young teen wants to do a business degree. During my business degree, I did internships at UBS Investment Bank. The first one was after first year in uni, and the second one was after third year in uni. So the first one was 2007, when the market was still sort of in a crazy territory just before the crash. So it was like there was suspense in the air, but everyone was still excited. And the second internship was 2009. Half of my previous team were gone, half of the floor was empty. It was quite depressing. I thought, you know what, don't want to do finance, don't want to do banking. It's horrible what it does to people's lives. Half of my colleagues were gone and like not doing too well, and the whole economy was not doing so well. So it was like a bit scary place. I'm like, okay, banking, no more for me. And at that point I made a decision of what I really want, because I was always, as a typical business student, you either kind of want to do investment banking or you want to do strategy consultancy. And I'm going to do strategy consultancy. And I've spent my final year in uni really attacking all the big strategy consultancy firms, the McKinseys, the Bains, the likes of the world. And eventually what I learned is that they pretty much only hire from their intern pool. And since I didn't have an internship with these guys, to get a graduate job there was impossible. And in my final year, I also did exchange in Hong Kong, where somehow, I'm not a native English speaker, English is my second language, I got offered a job to teach English in East China Normal University. Whatever that means, however that happened, I thought, okay, fine, you know what, I'm going to do like a gap year, teach English, and kind of refocus what I'm going to do with my career. And I was back home chilling for the summer, getting ready to go to China and have some fun. And I was reached out by an agent for a job in Jefferies, for a market risk job. And I thought, okay,
a market risk job.
A market risk job within the investment banking side. So it's a job where you sit on the trading floor, but it's more of a technical side rather than you're not on the business, but you're on the supervision side of the business. You're supervising others.
And before you were doing what at UBS?
At UBS, the first internship was quantitative risk control, and the second one was credit risk. So first, I was like, I had no clue pretty much what I was doing or what the department was doing. I was at such an early stage of my life that it was way above my understanding of the banks. It was very, very quantitative. But anyway, I thought, what a grown-up person would do is, of course, you have to take the job rather than go and have fun in China and do the exchange, the teaching job. So I went for the interviews, got offered the job. And the reason I took the job is because the risk team sits on the trading floor in Jefferies, because Jefferies is a relatively or comparatively small office in London compared to other big banks, like the Barclays, the JP Morgan, and all the like, where typically the risk department sits on a different floor. So I thought, okay, I'll take this risk job, and I kind of really wanted to move into trading, and I did that, and took me a couple of years to essentially make the move. I was, trying to network with all the traders on the floor, and the message I kept getting from all my friends and the pals, like, it's impossible. No one ever moves from sort of operating side of the business into front side of the business.
Because your mindset was what? You didn't want to get into banking. You didn't enjoy the 2 internships you had. But you had an opportunity to get back into banking, but within a slightly different guise.
Yeah, no. So the idea is what I thought I don't want to do banking. I want to do consulting. I couldn't get a job in consulting because they only hire from intern pool, and my interns were in banking. So, I was offered this opportunity, the gap year, not the gap year, the teaching position in China. And I thought, okay, that was kind of refocus my career. But then the opportunity came for a job in banking, and I thought, what a reasonable grown-up man would do. You don't take a holiday in China for a year, you take a reasonable job with a salary. You don't want to sit on your parents' bank account. So I thought, fine, I'll take this job. Because the consulting, of course, didn't work out, and the teaching job was more of a fun gig.
But you took the job in the banking, even though you didn't want to do it. But you sat on the trading floor doing risk.
Yeah.
Did you know you didn't want to do risk? And is that why you started networking around and trying to find out other parts of the bank and a seat that actually might suit you a little bit better?
So I always wanted. Again, my parents, my father is a businessman, entrepreneur. My mother works in the Ministry of Finance back home. So I always kind of had the idea I want to be the decision maker. I want to be part of the business. And in banking, if you are in the risk team, it's a vastly important job, but you don't make a business decision. You're not a profit center. And I thought, whatever I'm doing, I want to be the profit center. I want to be the one making profit for the company. I want to be the business decision maker. And when I joined the risk team, you see that all the alpha males, all the successful guys around you, and you want to be like that guy. You're 21 years old, and you see all the chat. It's inspiring, and you become aspiring to looking up to them. And half of the thinking was, fine, I want to be the decision maker, and I want to get that job because of that. But half of the thinking was just being a young guy and looking up to bigger, successful people and wanting to be like them and copying them. And I remember I was sitting not too far from the guy who was head of equity sales and trading, and I remember he was like a god. When he walks throughout the floor, it's like almost like a light follows him, the person on the stage, like really looking up to him, and like someone you can't even have a chat with because he's not approachable, but like you would be too shy. He's too senior, too important in the big investment bank. He's like, wow. I remember I knocked on his door and I said, hi, do you have a second to talk? I said, what's up? I said, I'd like to work for you. He says, oh, it's very, very brave of you to come to my office like that. And he started with a straight face. I'm like, oh my God, I'm going to be fired. This is the last day of my job. And it's like, well, I really like that. Come in, let's have a seat, let's talk. And I sat in his office, and he had like the biggest glass office in the whole floor. Like all my colleagues kind of see that I'm in different teams, biggest guy's office, sitting and having conversation. They're all like kind of peeking and looking around. But I told him what I like, what I want. I was very direct. He liked that I'm being direct. I said, okay, I like what I hear. Let's keep talking. And eventually, they didn't have an opening at that time. But within 6 months, there was another junior guy who quit. And they came to me, Karolis, do you want his job? I'm like, yeah, of course.
So what was that seat that you were in risk?
So I was in risk, and I was offered the job as equity derivatives junior trader.
And that is a hot seat, right?
As good as it gets. Yeah, to be a junior trader. So it was a desk of 4 people, a senior trader. I would have been the junior trader and 2 sales guys. I was like, wow. And to be a trader, you have to pass exams. You have financial regulations, securities, derivatives. So for a period of a month or 2, I did my risk job. I studied for the exams. And also in the afternoons, I would come and work at his desk as well, help him with all the stuff. And also learn it because derivatives, it's mega complex stuff. I would say if you anything close to rocket science, I think derivatives is as close as it gets to rocket science. And so it was really enjoyable, but I would say in reality, that job, my pay rise essentially was me getting a job, no pay rise. So you're still on no salary. And as a desk, as a business, essentially that business was set up more to facilitate sort of Jefferies becoming an all service investment bank firm. If there were clients who were trading cash equities and they want to trade derivatives, we'd have the facility to provide that. But we were not set up as a desk, at least at the time, for massive growth. And having not seen that massive growth and having not seen a significant increase in my sort of reward versus the stress you endure, I started looking elsewhere. And I always had, even in high school, real estate was in the back of my mind because I wanted to study architecture. But I never did any drawing classes, so that kind of door was shut from there early on. But my father, like I said, is a businessman. He's a sort of a one-man band real estate investor. My brother at the time was at Cerberus doing real estate as well in the big American private equity firm. So I always kind of wanted to do that, and real estate always attracted me from the childhood and just in general, an asset class that you can actually touch compared to derivatives where you trade an option on a chance to buy something in the future or something like that. So that attracted me, but it was very, very hard to break into sort of the real estate buy-side firms because everyone typically hire from investment banking, M&A guys who have years of experience in modeling cash flows. I remember the typical response I would have when I tried to have a meeting with someone is like, oh, you need genuine cash flow modeling skills. And I'm like, I can model Black-Scholes, I'm sure I can do some cash flow modeling. But no, Karolis, we hire people with at least 4 years of cash flow modeling. And it was very, very difficult to break that boundary. And then through another agent, another headhunter who was headhunting for investment banking positions, I said, look, not interested in investment banking positions. I'm trying to move into buy side on
the real estate side. But what I was going to interject and say is you worked so hard in order to get into banking. The door was closed to kind of pivot and go into consulting.
The pigeonhole.
You closed that and then you went back into banking.
Yeah.
You didn't like the risk piece, and you managed to hustle your way through to getting your dream job.
Yeah.
Which you actually realised you didn't like.
Yeah.
But you did that for a couple of years, right?
Yeah. Yeah.
And so you went through quite a lot of scrutiny and tests to get that.
So the story of it's not been easy because you kind of think what you want, then you don't get what you want, you get something else, then you think I want something else. So let's say I want into trading, you work your bum off to get into trading, you get it and you think, okay, what I thought my dream job was, it's not it. You get it and you realize it's so tough mentally when you worked so hard. It was really, really hard work of networking and just, learning stuff to understand what you're doing, to get into derivatives desk. And then realizing it's not something that's, swings your boat, that you're not enjoying it. So mentally you have to be very strong to say, okay, fine, it's not going to break me. I'm going to try and do something else. And that's when I tried to pivot into real estate. And then again, another wall, again, very hard to break into.
But before we come on to that, did you have an advisor or a mentor, outside of family or what have you, who advised on this particular route, or was it, or did you kind of just look and study and think, oh, that guy or girl's doing an interesting job, or they're driving a particular car, or they've got a particular lifestyle or what have you. That's what I'm aspiring to be. And I think if I can get into that seat and learn from them, I'll be able to get there. Or was it more, were you more considered and more like, these are the skills that I need to get based on a long-term goal than you reverse engineered?
So both. In reality, definitely had mentors and advisors because I'm a social creature. I like talking to people, and I would network with every member of the training floor. And some of them you get along better than others, and some of them took me under the wing and would give me advice how to approach, how to interview, how to ask for a job, how to network. And I had two particular people who were really looking after me and taking me under the wing. And some of the advice I got, for example, you go and you network and you meet someone and you say, anyone you met, even though they don't help you with the cause that you want, always ask, can you introduce me to the 3 people you think would be most valuable for me? And then a connection becomes 3 connections, and another connection becomes another 3 connections, and multiplies how to grow your network. So definitely got a lot of advice, and mentoring was a big part in my early career. And I tried to do the same where I'm now in my stage of life.
So before you moved into real estate, looking back now, at that time, what would you say your kind of your core skills were? What was the stuff, the value add that, because you touched on the cash flow modeling piece, it wasn't necessarily DCFs, right?
Yeah.
What was it, just like drive, a lot of self-belief and determination, commercial skills? Like what were the kind of the key things you think you had at that time in terms of your offering?
I would say persistence, acceptance of stress, and thick skin, and just being proactive, never to give up, keep trying, keep doing, a doer, a maker, a believer.
And so where...
I'm not sure that answers the question.
Yeah, no, it does. I'm just trying to understand in terms of like the value that you thought you could offer in the next role, looking back now, knowing what you know now about real estate and the skills required to be successful in real estate, going back to that time when you said it was like a brick
being
wall.
commercial, I guess. Being commercial is thinking how to turn a profit, how to make money. Not that it necessarily translates directly, but like seeking to create a profit for the company, be it for the desk, be it for whatever it is.
So just a commercial nose and awareness.
Because real estate is not a rocket science.
Deal structuring.
When I joined my company, I remember, again, I'll tell you more how I managed to join WP Carey. But I remember at WP Carey, when I joined, and still have very, very smart people, great mentors, and they taught me a lot. But I remember first day I asked my boss, my background is not real estate. Do I need to go onto a real estate course? Maybe read some real estate related book? What do you do? I'm like, Karolis, you're kidding? It's not a rocket science. You learn it on the job. And that's pretty much it. Real estate, all the skills you need, if you have done investment banking for a couple of years and you have your technical skills in running Excels and you know your math, it's fine. The math was my kick.
So you're strong on that side?
Yeah.
So you could always fall back on that and run a spreadsheet, work stuff out?
100%. Yeah. If you did investment banking and trading, especially math and Excel. I remember when I joined WP Carey, was said, first thing you do, build a model from scratch. I remember I spent a couple of weeks building a model. I put some VBA, automation, everything, and my boss said, "Okay, no automation. We don't need any VBA in our models. Keep it simple." So I think my skill set at the time was more than what you need in real estate in terms of building trading models. It's a bit more complex than building a cash flow model.
So you got to a stage where you're like, actually, I don't want to be an equity derivatives trader anymore. I want to get into real estate.
Yeah.
Why did you want to get into real estate? Was this kind of like another Karolis great idea of like getting to banking and then consulting and then derivatives, or were you kind of you were worldly wise enough and you took your time to kind of study and actually realise that actually you've got a self-awareness of your skills and the sector, and actually that is where you...
I would be lying if I told you I would only have considered a real estate job. My thinking was I want to go into buy side. Something that my mentor said, a couple other guys, one other trader on another desk said, Karolis, if you have a chance to move to buy side, forget the sales and trading and this whole sell side thing.
Why is that?
That's the future, because sales and trading, especially trading, being a personal trader, is becoming extinct because of all the automation.
And so if you can move to the buy side and be in control of the decisions.
Because you can't automate an investment officer's job. Deciding what to buy, where to buy it, be it private equity, buying a business, or being a real estate private equity where you're buying an asset.
Yeah, I guess AI and automation and other stuff can do a lot of it, or be able to cut some corners. But yeah, I understand what you're trying to say.
So it's easy, like automation in the sales and trading was way ahead. And desks were being closed because you can automate, you can algo trading and all that stuff.
Much cheaper, more efficient, and better return. So you kind of identified that, and then you wanted to get into real estate and move to the buy side after a mentor had kind of mentioned that to you.
And again, what helped me, like I said, my brother was already in real estate, private equity, and he had a lot of connections that I kind of leveraged on. But again, that didn't really pay off because they said you need genuine cash flow modeling skills. So I'm like, okay, fair enough. Fine, let's see how that goes.
So what happened then? How did you try and make that move?
So I was approached for another job in banking by a headhunter. I came to see him and I said, look, I don't want to do any more investment banking, but if you see another role, through your connections, through your personal network, that, a job comes up in, somewhere in the buy side, I'll be happy to consider something interesting, give me a call. And then I never heard from the guy. And then he calls me 2-3 months later, said, oh, hi, this is Andrew. Remember we spoke? Like, yeah, of course I remember. Somehow we connected. I think at that time I was getting ready for my marriage. We were engaged with my wife at the time, fiance at the time. I think he just had his first child. So we kind of somehow connected and had a personal relationship, which was very nice. And then he called me and said, oh, Karolis, there's a guy who's looking, he doesn't want to do a full doesn't want to launch a full sort of interviewing process, but he's asking for some smart candidates for an interview. Would you be willing to have a coffee? And I'm like, sure, of course, yeah, definitely have a coffee. And I was like, yeah, definitely, let's go. And had a coffee with my then future boss. Essentially that's how the interview process began. That was a very, very long interview process. First it was a coffee/breakfast, informal, just to get to know each other. Then I think they invited me for a beer, just to get to know me personally. Then I think it was, I was given a case study to write. I got some online tests to do, math online test. Then I was invited for another, I think, beer session, sort of meet us in the pub, let's chat. And after every episode, after every stage, not much feedback, and you're thinking, did I do well, did I not do well? I really like these people that I'm talking to, I really would like to work with them, but like, is this like 2 weeks quiet? Probably they didn't like me and they're never gonna hear back, so I would send a chase at this or that, how's it going? Oh yeah, fine, let's come for coffee. I'm like, fine. So then I had like a full day of interview process where I met him and all the rest of the team, which was like very, very impressive. And it's very nice when you interview and you're inspired by the people who interview. You're like, oh, I really want to be part of this team, part of this family.
And as part of that process, you're just learning more and more about the business and what you could do. And you're looking at your state as an equity derivative trader, going, that's where I want to get to.
That's
what I want to do.
Be. But also, like, not to badmouth investment banking, but like trading floor, there's a lot of alpha male mentality where the sort of the more arrogant you are, the cooler you are, the more aggressive you are, the cooler you are. Whereas when I met in our current firm at WP Carey, people were super sweet, super nice, super smart. As smart as any trader would be on the trading floor, or smarter, but generally very, very nice people, very friendly. And that really, I thought, here I can be more myself. Because in investment bank, you kind of have to build your sort of statue of like being an aggressive guy, make a doer, whereas here you should just naturally be a nice, good guy and do well, which really appealed to me.
So you ended up getting the job?
I ended up getting the job. I was very, very pleased.
And were you one of a few that got the job in a cohort, or were you?
I was the only hire. So the team was relatively small and they didn't hire that often. The only hire they had before me was 4 years ago, roughly. So they typically tend to have a small team, and we still have a relatively small light team today. At that time, I was the fourth guy to join, more or less, and we today have a team of 5.
So you're a team of 5 in London?
Today, yeah. There's been people left, people joined, but roughly keeping a small, lean team. We're busy when we are.
Yeah.
And, if you're not that busy, you don't have to lean, you don't have to do the difficult decisions.
So tell me about WP Carey. Like, who are WP Carey? Because they're a massive international business. They're probably better known in the US than they are over here. But, if someone listening to this maybe hasn't heard of WP Carey, can you just tell me a little bit about the business?
It's changing. It's definitely changing. I remember I called my brother, said, Ruckus, I got a call for a coffee for this company, WP Carey. And I assumed he would know. It's real estate. Have you ever heard of them? I was like, no, never heard of them. No, I'm like, what? Because look at balance sheet and everything. It's a big company. I said, well, they do Sale-Leasebacks. I'm like, what is that? I'm like, it's especially, that was roughly almost 10 years ago now. So then it wasn't that popular. Now I think we're a lot better known, even in Europe as well. But what is WP Carey? I say this so many times now because that's, my days are pretty much filled with calls and meeting people. And first thing you say, who we are. So, WP Carey is a REIT. We're listed in New York, on New York Stock Exchange. This year is our 50th anniversary. So we've been around 50 years, 25 years investing in Europe. But as a business, it's a cash flow business. So it's not a typical real estate fund where you buy an asset on a fund, you keep it for 3-5 years, try to change something, find a new tenant, do some amendments to real estate and sell it for more. We're a cash flow business. We buy real estate and we sit on the real estate. We collect rent and pay dividend to our stock investors. So the whole business model is, I think if you went online, I'm not sure if our current website says that, but essentially is providing secure long-term inflation protected income to our stock investors. And essentially, how do you do that? So for a stock investor to pay dividend, you need to have real estate to collect rent. And you want to make sure that the rent you collect is going to be stable, inflation protected, so all our rent is CPI linked or have fixed indexations. And what you want is to have tenants who are going to be around for the duration of the lease. So again, going back, we buy commercial real estate, any type of commercial real estate, anything except office, that is single let or single tenant, just strong covenant, so credit underwriting is a big part of the job. And we want the real estate to be what we call mission critical or operationally critical to the tenant. So essentially what we want is we want the tenant to be in the asset for the duration of the lease and beyond. We want tenant to survive difficult economic cycles. And when the lease comes to expiry, we want the tenant to renew the lease agreement, to stay there beyond the initial lease term. Because essentially for us, we want to be there as a financing party to the tenant. collect the rent. If they need growth, we can provide financing for the growth. But all business is cash flow model. Collecting rent, paying dividend.
Sounds great.
Sounds simple. It's relatively, you would think it's a vanilla simplified business model, but it's been around for a very long time. In America, there's more business who do that. In Europe, they're less so, but this long income stuff is becoming a lot more popular.
And so in terms of, in terms of your kind of approach to it, are you looking for businesses that hold a lot of real estate on their balance sheet that want to realize some capital? They're the kind of deals that you look for?
That naturally becomes the target sort of company that we work with, but essentially we don't really approach tenants themselves. All the deals come through the broker dealer network. So whoever wants to launch a deal, so the deal type of deals that we do. So one is sale and leaseback. What is a sale and leaseback? Sale and leaseback is, let's say, a manufacturing company has a manufacturing plant. They can go to a bank, they can lever that manufacturing plant, put a mortgage on it, get 60-70% LTV loan. They pay the interest, and 5 years down the line they have to refinance or repay the bullet. Or they can come to WP Carey, an alternative financing provider who does sale leasebacks, and do a sale and leaseback. Your purchase price essentially is your loan money, your rent is your interest, and after the lease term you can either give the keys back or extend the lease term, so it gives you optionality. Forgot the question, but yeah.
That's sell and leaseback.
Sell and leaseback, yeah. The second type of transaction that we do is build-to-suit financing. So again, could be, let's say, manufacturing company in America. They want to expand their presence in Europe. They want to build a factory, let's say, somewhere in Poland. They will approach a developer. What landlords can you offer? What locations can you offer? Let's say you find a developer who can build it for them. Developer would find a financing party, let's say us. We'd finance the development of the project by invoices every month. Essentially, the tenant or the manufacturing company does not have to put a single dollar until the factory is built, and on completion, the lease starts. So we negotiate the lease, development agreement before starting all the works, and we finance the construction. Developer doesn't put the money, the tenant doesn't put the money. We finance the construction, and on completion, the lease starts. We get a 20-year lease agreement with a great American company. They have a brand new asset that they didn't have to put a dollar in.
And then they've got the certainty of the term.
Certainty of the term.
And then you also have got the certainty around what your checks are going to be on a quarterly or monthly basis. And then you mentioned they're kind of inflation linked.
Exactly. So stability and security, inflation protected. And then the third type of transaction is net lease acquisitions. And net lease is a fancy word essentially for buying a deal or buying an asset that had a sale and leaseback done on it before. So the asset already has, let's say, 15-year lease. Let's say it initially had 20-year lease agreement, and another party did the sale and leaseback, and they have still 15 years remaining on the lease, and they want to sell the asset, we'd buy that asset with the existing long-term lease agreement in place already. But I would say the vast majority of transactions we do are sale and leasebacks. We do some build-to-suit as well, and we do some net lease, but the vast majority still are the original sale and leaseback transactions.
I guess you've got to be careful in this situation in terms of managing risk. You don't want to be too overexposed to one particular tenant in terms of percentage of your rent roll in case they do go bust.
So that's a fair point you make. So people say, Karolis, you say you never sell real estate, but sometimes you still do sell real estate. And selling real estate, again, my job is investment. So my job is to find new transactions, underwrite them, take them to committee, provide offers on them. If we secure an offer, negotiate the documents, and do all the way to closing, structuring, tax, and everything else. Anything that we sell is typically done by our asset management. But if I had to simplify the times when we would consider selling an asset, would be a risk management tool. So let's say we had a tenant, and that happens almost never, but in very rare occasions. Let's say we have a tenant, during the initial lease term, the tenant went bankrupt. We have a vacant asset, we try to find alternative tenant. If we don't find an alternative tenant within, let's say, 6-12 months, whatever it is, we would sell the asset. The second scenario is, let's say we had a 20-year lease comes to expiry, we have conversation with the tenant, would you like to renew? And for the reason, let's say they choose not to renew the lease. Again, we have a vacant asset. Asset management try to find alternative tenant. If they can't find a tenant, or we find a tenant with the lease too short that doesn't really fit our requirement, we'd sell the asset. And a third scenario is what I would call real risk management. Let's say you do your portfolio review and you say, we have too much, single name exposure. Let's say too much single company tenant exposure. And I think, we don't want to have too many eggs in one basket. Let's reduce some of that tenant exposure, sell a couple of that tenant's assets. Not all, but a couple, just to get exposure within the limit. Or you can say too much single country exposure. or too much sector exposure, let's say too much automotive or too much rocket science, whatever it is, to just reduce exposure. And other than these three scenarios, we never really sell real estate, which makes you not the best friend of brokers, because they make fees by people buying and selling real estate, and we buy and never sell. But I think we buy enough to keep people happy.
Talk to me about the different sectors that you operate in. Because it's not just industrial and logistics.
Yeah. So
you mentioned it's everything other than offices. Is that because of the change that offices are going through at the moment, or is that just because it just doesn't?
I think it was part of it, but again, we never really liked office. So my colleague says it really well. Anything that is attached to the ground and generates income, we're interested. So any sort of asset that you can attach a lease agreement to, we'd like to buy. And why we don't like office? So like I said, what we buy is we want to buy assets that have good, strong tenants. That's one thing. Office can have a strong tenant, but also want to have assets where the asset is very important to the operation of the business, and an asset from which is difficult for the tenant to relocate. Office is never difficult to relocate. It's almost cost-free. And the likelihood of the tenant staying in the same office outside of the initial lease term is very low, because you can move to a newer office next door. Whereas if you have a manufacturing plant that was built specifically for you, where you've been for the last 50 years, to relocate somewhere else to get zoning permission because of all the ESG and all the parameters, it's going to be impossible. Or if you have, let's say, a grocery retail store portfolio, for you to say, you know what, I'm not going to renew the lease on these 30 stores in whatever region you are, and I'm going to try and open new 30 stores, it's impossible. You're never going to get the zoning, the land, and everything else to do that. You can't sort of mimic that.
So you're pegged in with what you've with your existing footprint. It's very hard for you to kind of change.
Exactly. That. So, and that's the reason why we can't do. Office is never mission critical. You can never call office mission critical. So that's one of the reasons. Offices have been a very small part of our portfolio, because very few who want to sign a lease of 20 years on an office. I think typically they sign of 7 years or whatever that is, and B, criticality of it. But like other stuff, the things that we buy, so can be absolutely anything, can be, let's go for the asset classes. So let's say industrial and logistics. So it could be big box logistics, last mile logistics, a distribution center, can be sorting center, can be in terms of industrial manufacturing, can be sawmill, can be bakery, can be food production, can be food packaging, can be clothing sort of redistributor. And then in terms of retail, we also love retail. We can do grocery retail, portfolios of grocery retail, portfolios of DIY retail, sports equipment retail, automotive retail, all that kind of stuff. Then we can do R&D, life sciences, all the crazy stuff.
Talk to me, where does the REIT fit into this part of like the REIT structure? Why does that work in terms of Sale-Leaseback and WP Carey?
You don't have to be a REIT to do a sale and leaseback.
Of course you don't, but I'm saying why does a REIT work at the? Why is there some good synergy between being a REIT and also being
a REIT gives us access to the public markets in America, and we've been listed for quite a few years. I think 20 plus years we've been listed. So. And most of our competitors are, and that's the typical trend what you want to be. If you want to be a successful company and you want to be able to raise more equity on the public markets, you want to be listed as a REIT. And you don't have pressures from private investors to go and, the biggest problem what we face, especially that what we saw during the pandemic as well, where funds raise money from private investors, you sit on the burning pile of cash, you start paying your return from the money you raised, which is kind of Ponzi scheme in itself, and you can't find investments to do. Whereas being a publicly listed REIT, you have immediate access to capital markets. You can raise money when you need to. You don't need to raise when you don't have to, and you have enough money, and depending on your pipeline. So it gives you optionality and flexibility. And of course, the tax benefits in America.
Talk to me about your approach to underwriting, checking the creditworthiness of a tenant. How do you do that? And yeah, it'd be interested to kind of how you see how you kind of categorize that. So
any transaction that we do, let's say that's the amount of time I spend on underwriting the transaction. I would say 70-80% is looking at the credit, and 20-30% is looking at the real estate, the rents, the location, everything else. And then credit underwriting is we do everything in-house. So we go through balance sheets, income statements, cash flow statements, understanding the company, the competitors, the suppliers, supply concentration, customer concentration, geographical locations and strategy, all that stuff. Pretty much a deep dive into the credit. I would say maybe not as deep as a PE shop would do when they buy a business, but so pretty much close.
Because that's what you're effectively, buying it, but your risk is hedged against
We're buying a lease
business.
agreement, 100%. We're buying a lease agreement. And so, when we prepare for our committee, we do 60, 70 page memo. And, we go like through all the things, the financial statements, the business model, the board of directors, the management, the change in management, any recent sort of litigation process, everything. It's pretty much a deep dive. A lot of things to analyze. And that's why, for example, my background is banking, even though I didn't have, my background is trading more or less and the credit and the market risk. But most of our hires that we have come from sort of leverage finance background who did pretty much credit underwriting in and out of every single day in the life. So
because there's more synergy there than there is
100%.
taking someone from a property company or an investment management business.
100%.
Talk to me about ESG and sustainability within this, because I imagine if you did a deal 10 years ago, it probably wasn't too high up on the agenda 10 years ago, but we're looking at it now and we've got 10 years left. Occupiers will be looking at ESG compliant and the most sustainable buildings. Where does that fit into net lease investing? And obviously it sits on the asset management side, but is that a kind of a bit of a pinch point or a bit of a pain or a bit of a challenge at the moment? Not because it's not the right thing to do, but just more of it's a new headache or something else to get your head around in this current environment.
No, you're totally right. I think I've been to quite a few conferences lately, and one of the things, it's sort of like the hottest thing to talk about. Everyone is talking about it. Is the hottest topic at the moment in the real estate, apart from of course, interest rates and inflation. But one thing is, in terms of like looking at deals, how much do I pay attention to if the building is ESG friendly or not? Of course, if the asset is ESG friendly, that's a benefit for me. Would I reject a deal because the asset is ESG friendly? If I'm buying doing a sale-leaseback for a manufacturing plant, it's very unlikely it'll be extremely ESG friendly. So that's one thing. I would not reject a deal just because of ESG credentials, because for some real estate, it's impossible to be ESG friendly. But we try to have, and we tend to have very strong relations with our tenants. If the tenant comes to us and says, we're leasing this warehouse from you guys and we have another 20 years on the lease, energy costs are becoming very high for us. We'd like to install some solar panels. So we'd happily provide them financing and fund the installation of these solar panels, but that would be up to the tenant.
If they wanted to take it from you.
If they want to take it, yeah. But it's not that, our asset manager has an active strategy to sort of continuously talk to tenants and make sure that, we can provide all the help they need to make the asset as ESG as they want.
Talk to me, you just touched on prior to that, the kind of the wider inflationary environment. I think it's 8.75%, and obviously interest rates have just ticked up again recently. Is the space you're in protected by that? Do you mind so much about interest rates changing and inflation rates changing, or are you protected by it? And what's your view on it?
So full disclosure, I'm very, very bearish on the markets personally. And bearish, I mean, a lot of chat we hear is like interest rates are going to start coming down by the end of the year, everything stabilizing, normalizing. I don't really believe that. I don't see the reason why rates should go down. So my personal view is I think rates are where they are. They're probably going to go even higher, and I think they're going to stay there for quite a lot longer than people anticipate. And from that, I don't think the pain of increased cost of debt has yet seeped through the economy, and I think neither the households nor the business have felt it. So that's sort of my view on the markets. In terms of the business, people say, when should you do sale-leaseback? Is it good now when rates are high? Is it good when the rates are low? So when rates are low, it's a good reason to do sale-leaseback for a business, because you can get most value out of your real estate. Because when rates are low, yields are low, you extract most value. But when rates are high, it becomes a very good alternative to financing. So for example, in the best of financing times, you could do bank financing, say, around 1%. Let's simplify across Europe.
That would be good.
Yeah, somewhere around there. You could do a sale-leaseback maybe at those times, so 4, 5, 6%. Let's say take as average, let's say 5%. So 400 basis points gap between bank financing and sale-leaseback financing. Today, bank financing is around across Europe around, let's say, 6%. Sale-leaseback today can do 7, 8%. So roughly 100 basis points difference in cost. So we went from 400 basis points difference in cost between bank financing and sale-leaseback financing to roughly 100 basis points. So sale-leaseback as a tool is becoming a lot more competitive. A lot more CFOs are contemplating, my debt is maturing. What should I do? Should I go to the bank and refinance that? Should I do a sale-leaseback? And a lot more companies are contemplating to do a sale-leaseback to refinance the maturing debt. So high interest rate environment is actually good for our business because it prompts a lot more businesses to contemplate a sale-leaseback as a financing tool.
Which enables you to kind of expand and broaden your portfolio as well.
Come again?
Which enables you to expand, broaden your
100%.
portfolio, get some more transactions in there.
So,
as well.
and we're already seeing that. And it's not necessarily companies who are now really struggling because they need the money because they can't survive unless they do a sale-leaseback, but it's companies who proactively look for best way to finance and keep the balance sheets clean. And they think, okay, sitting on this real estate, we have this debt maturing, refinancing debt in the bank would cost us this, but why don't we extract value to the real estate and use that money to refinance the debt? So definitely creates opportunities. It's going to be a busy year. It is a busy year.
In terms of the lot sizes and the sizes of tickets that you write, it's quite a range. I think on your website it's like 5 million up to 500 million.
So typically, at least in Europe, we look for deals 15 million euros, pounds, dollars or higher. And typically anywhere below 15 million euros, the transaction cost make too big of an impact on the deal returns. So that's typically the threshold why we it's not a number you pull out of the hat. So 15 million, then sky's the limit. The largest single asset deal I at least worked on was 140 plus million pounds. The largest portfolio deal I closed was 190 million euros. The largest fund deal as a team we did the acquisition of another fund was over 2 billion euros. So it can be really, really large. We have all investors, sky's the limit. Today, as a company, if I remember correct from our last financial report that was published, we sit on roughly over $2 billion of cash to invest. So a lot of money to invest, a lot of money to deploy, and we have a good pipeline to use that for.
And talk to me about the assets under management and the portfolio you have right now.
Okay, so today our global assets under management are roughly somewhere $26 billion roughly, of which around 6-7 billion euros are within Europe. Our average lease term on the global portfolio, if I remember right, is around 11-12 years. So and that's the criteria what we buy comes kind of from that. Anything we buy, we want to extend our global average lease term, and that's why I want to do deals 10 years or more. And we haven't done a 10-year lease for a long time. I mean, most deals that we closed somewhere between 15 and 20 years, and that's why you want to keep having your global vault long.
Yeah,
that makes sense.
Yeah, because the longer vault you have, a weighted unexpired lease term.
For me, it kind of reminds optionality. Option loses value over time. Every day you come into the office and your option lost more value and more value. Theta, splitting theta. And so same in sale-leasebacks and long income business. Every day you come into the office, your average portfolio terms become shorter and shorter. So unless you keep adding new assets with longer lease terms, your portfolio is going to keep going down, and that's not great for risk management. So the pressure is there to keep buying. To
keep buying, keep extending it, and keep having that certainty of future locked-in, index-linked income over the long term.
Correct.
And I guess that's why, because day-to-day, operationally, it's not that intensive because the tenant is occupying and looking after it. Hence, why you can have a £6-7 billion European portfolio and there only be 5 of you in Europe.
So 5 of us is for the investment side. So we're doing investments.
Fine.
We have, if I tell you correctly, I think 25 plus people on asset management side. And essentially, you're right, you touch upon the right thing. So most of our leases are triple net, full indexation. And we always say we are a hands-off landlord. As a landlord, we want to be a financing partner to the tenant. Should they need to build new stores, we're happy to provide financing. Should they want to buy another business, do a sale-leaseback out of acquisition of that business, happy to do that. But we want to be not getting in your way, running your business. Essentially, we want you to run your asset as if you were running it before you did the sale-leaseback when you were owning it. So not staying in your hair, essentially. And that's pretty much the idea. Forgot the question again.
Who else is doing it? Or not who else? Yeah. Are there lots of other businesses doing this? And what types of businesses or institutions do you typically kind of compete against?
So people always ask me, who are your biggest competitors? So on a typical transaction, you're bidding on a logistics center. It can be anyone. It can be pension fund, can be a local family office. So competitor on a single deal can be absolutely any other investor. But the competitors of who else does things like us, there are not that many, but there are a couple, and we know them very close. But they're not that many. It's quite I think that if you look 10 years ago, there probably were 70% less competition. The competition is really very, very recent and helps us because we've been there for 50 years and they kind of mimic what we do, which is good. It's a proof of concept, When you see other people doing the same thing, you think, okay, we're doing something right.
In terms of the space itself, is there enough variety and interest and challenge to keep someone of your ability, interested? I talked to a number of people across the space, and they want to get involved with like more complex deals and things that maybe challenge or operational businesses. And maybe more kind of challenging transactions. And I'm not trying to say this isn't challenging, because absolutely it's a slightly different angle and a different lens of which you're looking at real estate. Because it seems like it's an accumulation game, as you said, in terms of just pushing out your WALT as long as you can and keeping the funnel topped up, and then making sure that you're re-upping when those leases expire to kick the can out further, and then it's just you're sat on the income.
No, 100%. So, for example, if I compare, I always talk to my pals in the industry and my brother. Some businesses, you buy an asset that is troubled, that needs new investment, finding a new tenant, changing the purpose or the use of the asset, and it's more like solving a puzzle. So you sort of investment manager where you solve a puzzle and try to extract more value out of the real estate. Whereas in our job, in my job as investment guy, my job is to deploy money. Deploy the capital that we have and find new transactions. So it's exciting because I keep doing deals in different countries. One day I'm talking with someone in Sweden, another day I'm talking with someone in Spain, another day I'm talking with someone in Poland. So I get satisfaction in talking to people across all many different cultural backgrounds. So that's very enjoyable. 2, it's a very social job. So I get to talk to a lot of people, which for me, being a social creature, I really like that a lot. Some deals are more structured than others, but typically, there's structuring in tax, there's structuring in, if you do like a portfolio acquisition, cross-country acquisition, cross-asset class acquisition, there's a lot of structuring to do. So you can get better in the model and in the numbers. So there's
lots of different areas that you can be challenged and learn and grow.
100%. And then credit underwriting, can I get comfortable with this credit? Is the sector strong enough? Is the future in this growth? Especially if you look in those sectors like automotive or solar power or anything like that, like trying to figure out not only if the business is going to be there, but will the industry be there in next 10, 20 years.
Yeah, that's a really interesting point. I guess AI and the rate of industries and how they're changing in regulation and sustainability and impact, where that fits in. You're almost betting and trying to find the next 100%. Industry that is going to be making sure that the bricks and mortar is integral to the operation.
100%. Yeah, 100%. I mean, AI, I don't want to speak about AI because I know so little. AI is such a new thing that I don't think many people even know what it is. You see a lot about it in the media and ChatGPT and all that stuff, but what that really is and what it's going to mean, I don't think anyone knows.
What are you most excited about as we kind of sit here, start of July 2023, and we kind of like look out across the market? What are you and WP Carey most excited about?
I think again, I don't want to sound cocky or arrogant, but I'm excited about, I think, the volume we're going to see coming to market from the pain of the interest rates that is going to have on the businesses. And I think that's going to create a lot of opportunity for us to do sale-leaseback. So, now in the summertime, I think we're going to have probably, I expect and I'm preparing to be extremely busy in the autumn and extremely busy in Q1. Because typically from what I read and from what I gather, it takes 12 to 24 months for increased rates to filter through economy. Now we only had a year since the rates started going up. In the next 12 months, we're going to have, full impact of, rates where they are today. And that's going to be felt. You see the research reports. And again, that's the BR in me speaking, but you're going to see, the pain in business and companies where they're like, okay, I'm gonna have to be proactive. I'm going to do something. And Sale-Leaseback is probably going to be something on their mind, I hope. And that's going to be I call it a harvest season for us. So that keeps me exciting. I'm a bit scared about the global economic impacts, and on the families and households. That definitely scares me, but the possibilities of doing business and helping business as well by extracting value from the real estate is quite exciting.
In terms of kind of core skills, it sounds like the banking piece has obviously been an integral part in terms of your skill set. I know you wanted to go down the consulting piece.
Why would I have done that? Thank God.
But it seems like you've almost got that now in terms of your current role from a consulting piece. What skills Would you advise, or would you say to someone who's in a banking seat right now, or who wants to maybe move out of the sell side to the buy side, what advice would you give someone sat there who wants to make the move over?
I would say commitment. So things I was asked, I remember when I was interviewing, one of the questions, which I remember really well, asked by my boss, or future boss at the time, was how put off or demotivated do you get by rejection? And I'm like, not at all. I just move on to the next thing. As my career speaks for me, and I try one thing, it doesn't work, and then I'm full of energy, I'm a ball of energy, try the next thing and the next thing. And I think what he was referring to is like, you bid on a deal, you so many times bid on many deals, and how do you not get demotivated? But you bid on a deal and don't win it, and like, don't get emotional about it. You move to the next deal, some win, you win some, you lose some deals, but always stay positive and stay hungry. And stay active and be proactive, not reactive.
And then from a technical perspective, so if that's behavioural advice you'd give, from a technical perspective, what kind of technical skills would you advise?
I don't want to downplay the complexity of real estate, but it really is not a rocket science. You don't need to be a quant to do real estate. Anyone who got into investment banking is typically smart enough technically to get the job done. The biggest thing is commitment to the job, commitment to doing the long hours, commitment to your role, to travel. I think that's what you need, the motivation.
I guess those individuals might lack the network. How important has the network been for you in terms of joining the sector?
No, not at all. Network is something you build over time. So when I joined the company, I joined as someone called second vice president. We used to have sort of military rankings at the time. And I was told, Karolis, you join as a junior guy, sourcing deals is not on your shoulders. That weight is not on your shoulders yet. Your job is, write memos, run models, analyze everything, do whatever you're told. If you source a deal, great, but you're not paid on sourcing yet. And that typically comes in from the time you reach vice president level. I was lucky to source before I reached that level. I think I sourced a deal in my first year, which I was very, very proud and cocky about. But first year, as you just learn, and by learning is, you travel with your boss, you travel with your senior colleagues around, and you develop network for your travels and for your senior colleagues. So there's no requirement to joining industry to have a network.
But the importance of it over time?
It's massive, 100%. The value of me to the company is the people I know. Because anyone can run a model. Most junior guy in the team can run a model as good as me probably. But the connections I have in the industry, the relations that I have is why I'm doing what I'm doing.
Karolis, as we draw to a close, the question I ask everyone on the podcast is, if I was to give you £500 million of equity, who are the people, what property, and which place would you look to deploy that capital? Yes, you can have your team, but if I'm going to really push you on where the types of assets, can you give me a bit of a flavour of where you look at deploying that?
So I listened to quite a few of your podcasts, and I know you ask everyone that. And I was thinking about, I would be a bad investment guy if I didn't tell you, give that money to me. I know what to do with the money. I'll do what I do every day. I'm an investment officer, so I would do exactly what I do every single day. I would deploy searching for sale-leasebacks, for good credits, for long tenants, for long leases, for strong credits, that kind of stuff. If you say, what location or what asset class, we are location agnostic. Do I care if I invest in an asset in Norway or in Sweden or in Italy or in France? Not really. As long as that asset is critical to the tenant and the tenant is having is a big successful business. So I would say today, be diligent about pricing, because I do expect pricing to shift out, because I do expect more pain to come through the economy. So don't overpay. Be diligent about underwriting credit, because I think while companies might be doing now, for example, very simple analysis, people say, maybe there's pain for the economy, but logistics sector is doing tremendously well, there's rental growth, and everything's going to be, peaches. My counter argument is this. People are estimating that companies who use warehouses, let's say retail companies, going to have the same retail growth that they did during the pandemic. That's not sustainable. Pandemic was an outlier in the whole 20 years time, when people just bought stuff they don't need with the money they don't have, and that retail growth is not going to go there. Then these retail companies took up warehousing space, expecting this growth, retail growth to go in the same direction, and they took more space than they need. So what we have now in the market, we have invisible vacancy. We have retailers who have warehouse that they only use 70% of. And then all the other investors are buying warehouse and think, okay, I'm buying now, the cap rate might be seeming a bit too tight, but there's so much rental growth that my reversionary yield is going to be super fine. Well, I think people are massively overestimating the rental growth. I'm sure it's going to be there, but I think people overestimate how much rental growth they're going to be in the market because of the vacancy. Because if the economy goes into recession, people are going to buy less stuff. Retailers are going to sell less stuff. You sell less stuff, you need more room to stock it. So everything is affected. You think that whatever happens somewhere doesn't going to affect you, everything's going to be affected. So be diligent in your underwriting, be conservative, manage your risk, and just do what you do best.
If I was to say, Karolis, you can't get any sale and leaseback deals, you can't do any build-to-suit finance deals, and there's no net lease acquisitions or tenant partnerships, where would you put the 500 million quid?
Index. I remember my boss on the trading floor, I asked, like it's the first day on the trading day, I'm like, oh, what do you do with your own money? What advice can you give? But he was like, Karolis, I don't gamble with my own money. I wouldn't do any stocking. I would do like index. I think index is the best thing. If you don't use your specialty skill to do what you do best, which for me is Sale-Leaseback, net lease investment, I'll put in an index. Safe.
What, S&P 500?
Yeah, simple index. Diversify a couple indexes, but yeah, nothing more complex than that. If you look again, jokingly, along people who started the businesses like Donald Trump, they say, it's anecdotically, he started his empire with a small loan from his father of $1 million, and people say if he had put that $1 million on S&P 500, he would be way wealthier today than what he has doing it himself,
doing his own real estate deals.
Yeah. So sorry to disappoint with my answer, but it's I can't speak for what I don't understand. So what I understand is sale-leasebacks. I don't invest in stocks.
I was going to say, cut you in half. You'd bleed sale and leaseback, and committed, index-linked, inflation-protected income with as long a WALT as you can,
100%.
as diversified and risk managed as possible.
I was buying a new car, and I was being so close to being an idiot. And I was thinking, should I get like special number plate or not? And I was still I want to get the SLB plate. SLB, and I was like, you Karolis, an idiot. But yeah, sale-leaseback is what we do.
You just want that consistency.
Yeah.
And I guess liability matched, right? So you'd probably liability match a new car against your index, whether that's the S&P 500 or against real estate. Well, look, Karolis, thank you so much for joining me on the People Property Place podcast. I'd love to find out a little bit more about your background, some of the hurdles that you faced in your kind of career, how you've kind of pivoted, doubled down, and really driven your career forward, and excited to go and see what you and the team go and do in terms of taking advantage of any sort of dislocation that's there in the market at the moment.
Absolutely, man. Thank you so much for having me. I appreciate it.
Cheers. Thanks. Thanks for listening to this episode of the People Property Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests we should get on the podcast or areas of the market we should explore further. So do drop me a message. The People Property Place podcast is powered by Rockborn. The team recruit experienced talent for investors, owners, developers, and operators. So if you're considering your career options at the moment or looking to attract top talent to work for you, head over to the website www.rockborn.com, where you can find a wealth of research to aid your search. Have a great day wherever you are, and I look forward to catching you next time.